The trajectory of the cryptocurrency market is on a collision course with a singular monumental event: the potential passage of what is broadly termed the Clarity Act in 2026. This is not merely another piece of financial legislation. It is the master regulatory switch that could illuminate a decade of regulatory shadow and confusion. For years, the industry has operated under a cloud of uncertainty, with the fundamental question of is this a security or not? Left to interpretation, legal battles, and fragmented state-level rulings. This ambiguity has acted as a brake on institutional capital, a deterrent to mainstream product development, and a source of constant existential risk for projects. The Clarity Act promises to cut through this fog by establishing a definitive federal-level framework that explicitly separates digital assets that are securities from those that are genuine utility tokens or commodities. This legal delineation is the non-negotiable prerequisite for the market's next evolutionary phase. The immediate impact of such clarity would be nothing short of a market-wide repricing event. Imagine a landscape where every token, from the largest by market cap to the newest DeFi project, is suddenly reevaluated against a clear legal standard. Assets deemed utility tokens would be liberated from the crushing compliance overhead and legal peril associated with securities law. This would unlock their potential for innovation, development, and integration into traditional financial rails. Conversely, tokens classified as securities would have a clear, albeit rigorous, path to compliance, providing a stable environment for their investors. This overnight reclassification would trigger a trillion-dollar capital migration as institutional allocators, who have been waiting on the sidelines for precisely this kind of legal certainty, deploy capital at scale. The capital would flow away from projects mired in legal uncertainty and towards those with validated utility or clear compliance pathways, creating a seismic shift in market leadership and valuation models. However, the path to this inflection point is fraught with political peril. The Clarity Act does not exist in a legislative vacuum. Its fate is intrinsically tied to the broader, often dysfunctional political machinery in Washington, D.C. The primary obstacle is not necessarily opposition to crypto itself, but the omnipresent threat of political gridlock over more domestically salient issues. As highlighted, debates over foundational policies like healthcare have the proven capacity to consume the entire legislative calendar, pushing other critical agendas, including financial innovation, indefinitely to the sidelines. Lawmakers may express support for regulatory clarity in theory, but in practice their priorities are dictated by electoral pressures and partisan standoffs. Therefore, the single greatest risk to this catalyst is not a no vote, but an endless delay, a perpetual next session, where the bill is held hostage to unrelated political maneuvering. Investor strategy, therefore, must be bifocal. First, it requires diligent monitoring of the specific legislative language and political sponsorship of any forthcoming clarity bill. The details, such as the exact definitions, the role of existing regulators like the SEC and CFTC, and the treatment of decentralized networks, will determine the true winners and losers. Second, and equally crucial, is tracking the broader political calendar and partisan tension. A period of intense conflict over government funding or social policy could signal an impending stall for all non-essential legislation. The convergence of a technically sound bill with a rare window of bipartisan cooperation and legislative productivity is the specific trigger to watch for. In essence, the 2026 catalyst is not just the act itself, but the alignment of political will with regulatory necessity. When and if that alignment occurs, it will not be a subtle market nudge. It will be the definitive starting pistol for a new era of institutional capital deployment and legitimized innovation, resetting the foundation of the entire digital asset economy. The year 2026 is poised to dismantle one of the most enduring yet fragile market myths: the political independence of the Federal Reserve. The catalyst is the confirmation process for a new Federal Reserve chair, an event that will transition the central bank from its traditionally perceived role as a technocratic institution into an openly debated and potentially more politicized body. This shift is not merely a change in leadership. It marks the culmination of a multi-year trend where monetary policy has become a central plank of political discourse, moving from the opaque language of font minutes to the explicit demands of political campaigns. The confirmation hearings themselves will serve as a national referendum on the future of inflation targets, employment goals, and, most critically for crypto, the strategic use of the Fed's balance sheet as a direct economic tool. This transition spells the end of the so-called Fed put as markets have understood it, the implicit belief that the central bank would act as a neutral arbiter to backstop markets in times of severe stress. In its place, we enter an era of orchestrated economic planning, where the objectives of the executive branch could exert unprecedented influence. We are already witnessing a preview of this future. Prominent political figures have begun publicly discussing interest rate policy, even floating the idea of raising rates to combat persistent inflation. Such direct commentary on the Fed's primary lever shatters the illusion of an ivory tower, signaling to investors that monetary policy will be viewed through an overtly political and electoral lens. The new chair, therefore, will not just be a seasoned economist, but a political operator, navigating a mandate that balances economic stability with unspoken political imperative. For the cryptocurrency and broader risk asset markets, this translates into a direct and volatile relationship with explicit political sentiment. Liquidity, the lifeblood of bull markets, will no longer be governed by a predictable data plot. Instead, its flow will be subject to the political winds, the administration's tolerance for market volatility versus inflation, and public pressure. A more politically responsive Fed could mean accelerated or more aggressive easing cycles ahead of key electoral periods to stimulate economic sentiment, potentially creating massive short-term liquidity injections into risk assets. Conversely, it could also lead to prolonged restrictive policy if battling inflation becomes a political badge of honor, starving markets of capital for longer than traditional models would predict. The immediate consequence is that Fed policy becomes a primary front-page market driver for crypto, not a background macroeconomic factor. Traders will need to parse political speeches, electoral polling data, and congressional testimony with the same intensity they once reserved for CPI prints and payroll data. Confirmation window in 2026, potentially running through mid-year, will be a period of extreme uncertainty. A delayed confirmation or a contentious hearing could create a policy vacuum, where markets operate without clear leadership at the world's most powerful central bank, leading to heightened volatility and a defensive posture from institutional capital. Thus, the 2026 Fed transition is a double-edged sword. It unlocks the potential for politically motivated liquidity surges that could propel asset prices, but it also anchors the market to a new, less predictable source of systemic risk. Successfully navigating this new landscape requires investors to adopt a political economist's mindset. It will no longer be sufficient to understand monetary theory. One must also forecast political strategy. The central bank's balance sheet will transform from a technical tool into a political scoreboard, and its management will be the single most important variable controlling the availability of capital to fuel or stifle the next generation of digital asset growth. The next crypto bull market will not be powered by speculation alone, but by a fundamental, tangible shift in the source of its underlying value. The mass digitization and on-chain representation of real-world assets, RUA. This movement, often called tokenization, represents a paradigm shift from creating value ex nihilo through memes or novel protocols to digitally mirroring and unlocking the value of the existing multi-hundred trillion-dollar global economy. The record-breaking ascent of gold transforming into a $30+ trillion asset class is not an isolated event, is the proof of concept and the opening act. Gold's successful tokenization on platforms like Ethereum demonstrates a scalable model for converting a universally recognized store of value into a programmable, instantly transferable, and composable digital asset. This is the prototype for a financial revolution. This process is poised to sweep through the foundational pillars of traditional finance. We are on the cusp of seeing U.S. Treasuries, corporate bonds, real estate equity, and critical commodities migrate on-chain. This migration does not change the intrinsic value of a Treasury bill, but it revolutionizes its liquidity, accessibility, and functionality. By wrapping these assets into tokenized forms on public or permissioned blockchains, they escape the siloed, hour-limited. They become tradable 24/7, divisible to microscopic amounts, allowing fractional ownership of a commercial skyscraper, and capable of being used as programmable collateral in DeFi lending protocols or as settlement layers in complex derivatives. This creates unprecedented digital liquidity pools, tapping into previously inert or institutionally hoarded capital and bringing it into the dynamic crypto-economic ecosystem. This is the critical evolution of the market narrative, from speculative narratives to asset-backed utility. For years, a project's value was largely driven by its community, its technological promise, and its speculative momentum. While these factors will remain, the RUEV introduces a powerful balance sheet-anchored metric: real-world, yield, and verifiable, off-chain collateral. A token representing a share of a revenue-generating real estate portfolio or a yield-bearing treasury bond carries an intrinsic cash flow and a claim on a physical asset. This provides a fundamental valuation floor and attracts an entirely new class of investor: the institutional portfolio manager seeking yield enhancement, the family office looking for transparent asset ownership, and the risk-averse retail investor wanting exposure to traditional assets with modern efficiency. The infrastructure for this transformation is not a futuristic concept. It is being coded and deployed right now. Blockchains like Ethereum are undergoing upgrades, e.g. Glamsterdam, specifically focused on enhancing scalability, privacy, and compliance features, key requirements for institutional RIA issue. A new ecosystem of specialized protocols is emerging to handle the crucial oracle function of proving real-world asset ownership and value, and to manage the legal and regulatory compliance tied to these assets. This quiet, back-end build-out is the most bullish signal of all, indicating that the foundational rails for a multi-trillion-dollar movement are nearing completion. Therefore, the 2026 catalyst is the operational scaling and regulatory accommodation of this tokenization infrastructure. They are investing in anticipation of the liquidity wave from RUA tokenization, the user wave from prediction markets and gaming, and the regulatory clarity that will unlock institutional mandate. Therefore, the 2026 catalyst is not a single event, but the moment this stealth phase transitions into public acknowledgement. It's the point where the cumulative effect of years of quiet development and accumulation becomes undeniable. When a major sovereign wealth fund discloses a Bitcoin position, when a Fortune 100 company announces its treasury is now tokenized on-chain, or when the upgrade Ethereum network effortlessly settles a transaction volume exceeding a traditional financial network. For the astute investor, the task is to ignore the noise and monitor the signals of construction. The on-chain dashboards showing whale wallet growth, the GitHub commit history of core protocols, and the testnet progress of major upgrades are more valuable indicators than social media sentiment. The next bull run will not be announced with a bang. It is currently being assembled, component by component, in the quiet workshops of developers and the cold wallets of patient capital. Recognizing this silent build is the key to positioning ahead of the crowd's eventual, thunderous arrival. The most profound and perhaps underrated catalysts for 2026 lie not in boardrooms or legislative chambers, but in the daily habits and entertainment of hundreds of millions of people. This is the thesis of the mainstream domino effect, where adoption is not driven by financial speculation, but by utility, entertainment, and social competition. Two sectors are poised to act as these dominoes: the explosive growth of on-chain prediction markets and the integration of tokenized digital property into blockbuster video games. Their power lies not just in user numbers, but in their ability to trigger an irreversible shift in how the global population understands, interacts with, and psychologically values digital ownership. Prediction markets are currently experiencing a Cambrian explosion of growth, moving far beyond the niche of political betting. Platforms are witnessing monthly volumes scaling from millions to billions of dollars. While sports betting provides the initial onboarding funnel, the true total addressable market, TAM, is human curiosity itself. We are moving toward a world where people can make micro bets on everything. Corporate earnings outcomes, film box office results, the launch date of a tech product, or local election results. This transforms passive consumption into active, vested participation. The crypto rails, specifically stablecoins for seamless, borderless settlement and decentralized Oracle networks for tamper-proof, real-world data, are the only infrastructure capable of supporting this global censorship-resistant activity at scale. This sector's projected 10x growth will not just enrich its protocols, it will serve as a mass, global onboarding ramp. Millions will first interact with a blockchain not to invest in crypto, but to place a $5 bet on the Oscars. In doing so, they will nonchalantly create a wallet, acquire stablecoins, and execute a smart contract. The psychological barrier to entry evaporates, replaced by a focus on the engagement and potential reward. Parallel to this, the gaming industry represents a sleeping giant of cultural transformation. When a title with the cultural gravity of Grand Theft Auto 6 inevitably integrates true digital ownership, where in-game items, vehicles, or property are not just pixels on a server, but verifiably owned assets on a blockchain, it will create a mainstream blueprint overnight. This is not about niche play-to-earn Web3 games. This is about inserting crypto economic primitives into the multi-billion-dollar entertainment products that already command audiences larger than the populations of most countries. The moment a 16-year-old player in Ohio truly owns a rare, tradable skin earned in a game and can sell it peer-to-peer to a player in Japan for digital currency without publisher permission or fees, a fundamental cognitive shift occurs. The concepts of digital scarcity, verifiable ownership, and peer-to-peer value transfer cease to be abstract financial concepts and become lived, intuitive experiences. The convergence of these two forces, prediction markets and gaming, creates a powerful, self-reinforcing adoption loop. A user onboarded through gaming understands digital wallets. A user onboarded through prediction markets understands instant settlement. Both are then primed to explore other facets of the ecosystem, from DeFi to digital art. This is the domino effect. Each new utility-based user makes the next wave of adoption easier, cheaper, and more socially normalized. For 2026, the catalyst is the crossing of a critical mass threshold in user experience, UX, and cultural acceptance. It's the year when the friction of onboarding drops to near zero. Think social logins and gasless transactions abstracted away. And when the media narrative shifts from crypto scams to the technology powering the next generation of gaming and social interaction. The investment implication moves beyond betting on which game will succeed. It focuses on the underlying infrastructure enabling this future, the scalable, low-cost blockchains that can handle millions of microtransactions, the middleware that allows game studios to integrate digital ownership without becoming blockchain experts, and the identity reputation systems that will emerge from these new digital economies. When adoption is driven by play and participation rather than financial fear of missing out, FOMO, it creates a deeper, more resilient, and ultimately unstoppable foundation for growth. The 2026 bull run will be fueled not just by capital, but by the energy of hundreds of millions of people finally, and perhaps unknowingly, living on-chain.